Welcome to the deep dive. Today, we're tackling a really common question. You've got $1,000 saved, money you can actually afford to invest. What now? What are the clearest, best ways to put that money to work? We've dug into some great advice for this, specifically from an investment banker, someone who managed wealth for the super rich for years, then retired early. And he distilled it all down to 10, well, pretty simple options for beginners. Our mission today: cut through the noise, give you a clear comparison of these 10 choices fast, so you walk away knowing which path or paths might actually fit your goals and how much risk you're comfortable with.
Yeah, and the backdrop here is really important. It's about how investing has opened up. Think back just a generation. A lot of these tools, they were strictly for people putting in six figures, minimum. Now, whether you want something super stable or you're looking for, higher risk, higher reward, technology means that $1,000 can get you in the game, access the same markets.
Okay, so let's start where pretty much everyone says to start: the foundation, passive diversified investments. And top of that list, index funds.
Index funds are beautifully simple, really. Instead of you trying to guess the next big winning stock, the fund just copies a market index like the S&P 500, the 500 biggest companies in the U.S. So you buy just one thing, one fund, and boom, you own a tiny slice of hundreds of companies.
Right. So for someone starting with just that $1,000, what are the big wins there? Straight away.
Well, two things jump out immediately: safety and cost. Diversification means safety, basically. You're spread across so many companies. If one or two have a bad run, the overall market effect is often smoothed out. Less volatility, but maybe even more crucial for a beginner: they're passively managed, meaning there isn't an expensive manager actively trading trying to beat the market. They just track it. And that lack of active management means the fees, the expense ratios are usually super low.
And those low fees are huge with
Yeah.
just $1,000, right? Every fraction of a percent counts.
Exactly. High fees just eat away at your starting capital much faster. Index funds let more of your money actually work for you. It's this simplicity, this low cost, that makes people like Warren Buffett such big fans for long-term growth. He basically says markets tend to go up over the long haul, so just matching the market is a solid strategy.
Got it. Good examples would be like the Fidelity 500 or the Vanguard 500 index fund.
Precisely. Those are classic, widely available options.
Okay, that leads us nicely into number two, which feels like a close cousin: exchange-traded funds, or ETFs. They also track an index, like an index fund, but what's the key difference in how they work? The flexibility part.
Yeah, the main difference is how and when they trade. An index fund, like a traditional mutual fund, only prices and trades once a day. After the market closes, at what's called its net asset value, or NAV.
Hang on, NAV. For someone totally new, what is that, simply?
Ah, right. Good question. NAV is just the total value of everything the fund owns, all the stocks, bonds, cash, minus any debts it owes, then divided by the number of shares. It's the official end-of-day price per share. ETFs, though, they trade all day long on the stock exchange, just like shares of Apple or Google. Their price fluctuates throughout the trading day.
And that practical difference, trading all day, often means ETFs don't have minimum investment amounts, right? You could buy just one share, one unit, whereas some index funds might still need, say, $500 or even that full $1,000 to get started. So ETFs can be easier access sometimes.
That's often the case, yes. It removes a potential barrier for that initial investment. Okay, so we've talked ownership. Let's shift to lending. Option 3, bonds.
Bonds. So, super simple terms: I'm lending my money to a company or maybe the government.
That's exactly it. You lend them money, they promise to pay you back the principal amount later, and along the way, they pay you regular interest, often called a coupon payment. Think of it like a paycheck for your investment.
And why would a beginner, maybe focused on growth, want bonds alongside stocks?
Stability. That's the big one. Bonds often behave differently to stocks. When the economy looks shaky and stocks are falling, investors often run towards safer things, especially government bonds, that can push bond prices up so they can smooth out the ride, dampen the volatility that can really scare off new investors. Plus, you get that predictable income stream.
But not all bonds are equally safe, are they? There's a spectrum.
Definitely not. It all depends on who you're lending to. This brings up the big difference between investment-grade bonds, which are loans to really stable companies or governments rated highly for safety. They pay lower interest because the risk is low.
Okay.
And then you have sub-investment grade bonds, or more commonly called junk bonds.
Junk bonds sounds risky.
They are riskier. These are loans to companies or entities that are seen as having a higher chance of defaulting, not being able to pay you back. So to compensate you for taking on that extra risk, they have to offer much higher interest rates. It's that classic risk-reward trade-off.
And you can buy these through your brokerage or often as bond ETFs or bond index funds too, like the Fidelity Investment Grade Bond Fund.
Yes, exactly. Bond funds offer easy diversification within the bond world itself. Something like the Schwab short-term U.S. Treasury ETF focuses just on safe, short-term government debt.
All right, shifting gears now. Let's talk automation and making things easy. Option 4, robo-advisor apps. These sound like, well, exactly what the name says, an automated advisor.
Pretty much. Think of it as a low-cost digital personal financial advisor. No judgment, just algorithms. You tell the app your goals like, I want to retire at 60, or I'm saving for a house down payment, and your risk tolerance. And its algorithms build and manage a diversified portfolio for you, usually using those low-cost ETFs we just talked about.
So beyond just being simple, what's the real value add, especially for a beginner who might feel overwhelmed?
Oh, automated services are key. Rebalancing, for instance. As markets move, your mix of stocks and bonds might drift from your target. The app automatically adjusts it back, keeping your risk level consistent. That's huge.
Things a beginner might not even know they should be doing.
Exactly. And some even offer tax loss harvesting, strategically selling investments that have lost value to offset taxes on gains elsewhere. That could be a real money saver over time.
What's the catch? There must be one.
Control, mainly. You can't pick individual stocks or bonds yourself. You're handing over the day-to-day decisions in return for that ease and automation. But the fees are typically very, very low, often much lower than a human advisor.
Okay. Now, what if you're not quite ready for market ups and downs, or you just need somewhere safe and accessible to park your cash, but you still want it to earn something decent? Option 5, money market funds, MMFs.
Right. MMFs are a type of mutual fund, but they invest in very specific things. Short-term, high-quality debt. Think short-term government bonds or certificates of deposit from big banks. Basically, they pool everyone's cash and lend it out for short periods, like 3 to 6 months, to very reliable borrowers.
And they're designed for what exactly? What are the goals?
3 core things: stability, liquidity, and income. Stability first, they're structured to keep the price, that NAV we talked about, very close to $1 or £1 per share. So your initial capital aims to stay stable.
Okay, that sounds safe.
Then liquidity, you can usually get your money out quickly without penalties, though you always check the specific fund rules. Easy access. And finally, income. They pay regular interest. And right now, this is where MMFs are really shining.
How so? What kind of returns are we seeing?
Well, our sources show top U.S. MMS yielding up to maybe 4.89% APR. In the UK, yields are around 4.95%.
Wow. Okay.
Now, think about inflation currently running about, what, 2.5% in the U.S., UK, Europe?
Right.
These MMS are actually beating inflation. So you're preserving your capital and increasing your real purchasing power. That's a fantastic result for such a low-risk place to put cash.
So examples like the Vanguard Sterling Short-Term Money Market Fund in the UK or Schwab Prime Advantage in the US.
Exactly. They're really worth looking at, especially in the current interest rate environment.
Okay, let's move into assets that feel a bit more tangible. Option 6, real estate investment trusts, or REITs. So this is how you invest in property without actually buying a building and dealing with tenants.
Precisely. A REIT is basically a company whose whole business is owning and often operating properties that generate income. Think shopping malls, apartment buildings, warehouses, even data centers or cell towers. And these REIT companies trade on the stock market, just like any other stock.
What's the big appeal here, especially for someone maybe looking for income from their $1,000?
The dividends. It's baked into their structure. By law, REITs have to pay out at least 90% of their taxable profits to shareholders as dividends. So you're effectively getting a share of the rental income collected by the REIT's properties, usually paid out quarterly. It's a steady income stream.
So, quick math. If I put my $1,000 into a REIT that has a 7% dividend yield, I'd get about $70 back over the year, just as income.
Yep, that's the basic idea. Plus, you get diversification because property often moves differently than the stock market. And unlike physical property, which takes ages to sell, you can sell your REIT shares anytime the market is open. Instant liquidity. Think companies like Public Storage, Prologis, or Realty Income, big names in the REIT space.
Okay, now we're definitely shifting gears towards the riskier end. Option 7, crowdfunding platforms. This lets regular folks like us invest in brand new startup companies, right? Something that used to be just for venture capitalists and the super wealthy.
Exactly. Platforms have sprung up that allow you to invest relatively small amounts, sometimes as little as $100, to buy a small equity stake in very early stage businesses.
And the potential upside is
Huge. Astronomical, potentially. If you happen to pick the next Google or Amazon when it's just starting out in a garage somewhere,
yeah.
that tiny initial investment could multiply many, many times over. It's also diversification away from established publicly traded companies.
But hang on, let's be really clear here. We're talking startups. Our source material mentioned, what, a 90% failure rate for startups?
Yes, and this is absolutely critical.
So is advising a beginner with just $1,000, maybe that's a big chunk of their savings, to gamble on something with a 90% chance of going to zero? Is that responsible advice?
It's a fair challenge. And the answer from the source, the retired banker, is nuanced. Yes, it's included, but only for a very specific type of investor and only with a tiny portion of capital. This is absolutely not where you put money you can't afford to lose. Think of it as the speculative fringe of your portfolio. Maybe you take $50 or $100 of that $1,000 if you are genuinely seeking that moonshot potential and fully understand that it will most likely disappear entirely.
So strictly for risk seekers, fully aware of the odds, using platforms like Seed Invest or Crowdcube.
Precisely. You must go in with eyes wide open about the extremely high chance of failure. It's a lottery ticket, essentially, but one based on a business plan.
Okay, understood. Now for something completely different, but still a form of investing, option 8. Paying down high-interest debt or overpaying your mortgage. How does paying off debt count as an investment?
Because it offers a guaranteed risk-free return. Think about it. If you have a credit card charging you 22% interest,
Ouch.
paying down that debt is like earning a guaranteed 22% return on your money because you're no longer paying that interest expense. You won't find that kind of guaranteed return anywhere in the markets. For a mortgage, overpaying builds your home equity faster and saves you interest over the long term. Plus, there's a huge psychological benefit. Reducing debt lowers stress and frees up cash flow for future saving or investing.
Makes sense. A guaranteed return is hard to beat. Okay, option 9 flips that investing in yourself by starting a micro business or a side hustle with that $1,000.
Absolutely. This is investing your own skills, your own potential. Every huge company started small, right? And today, the barriers to entry are lower than ever. Tools are cheaper. Platforms like Etsy or Shopify make selling easy. The internet gives you global reach. AI can help with marketing.
Yeah.
That $1,000 could be enough for a website, some basic equipment, initial inventory, or maybe some skills training.
The potential return.
Unlimited, technically. Because you are the business. There's no middleman taking a cut, except the platform maybe. You build skills, confidence, and potentially a long-term income stream that you control.
But the reality check, it's not passive income, is it?
Not at all. There's absolutely no guaranteed return. It takes serious time, consistent effort, resilience when things go wrong. You have to wear all the hats, sales, marketing, product, service. It's demanding. But the payoff, if successful, can be far greater personally and financially than just market returns.
All right, that brings us to the final option, number 10. And it's definitely the most talked about, maybe the most controversial, cryptocurrencies. You know, it's fascinating how this has gone from niche internet money to something even major financial institutions are now trading.
It is. And we have to approach this one with extreme caution and balance. The potential upside, it's undeniable. Look at Bitcoin's journey over 16 years, from basically zero to tens of thousands of dollars. That kind of growth is, well, historic. It also offers diversification. It's a different asset class that doesn't always move in line with stocks or bonds. And when you look beyond Bitcoin at things like Ethereum or Solana, you're arguably investing in the underlying technology, the blockchain infrastructure that could power Web3, decentralized finance, NFTs.
Okay, the potential is clear, but the risks, they seem just as significant.
They are massive. First, volatility, extreme volatility. Double-digit percentage swings in a single day are common. That's tough for most investors to stomach. Second, regulation and investor protection are still evolving. Laws, taxes, is a moving target globally. Third, the risk of personal loss is higher. Forget your password or key phrase. Your funds could be gone forever. Get tricked by a scam. Often, there's little recourse.
So the advice here...
Research. Research everything. Understand what you're buying. Use reputable, regulated exchanges like Kraken or Coinbase. Start small. And the absolute golden rule, even more so than with startup investing. Only invest money you are fully 100% prepared to lose. Treat it as purely speculative capital. You can also get exposure now through regulated crypto ETFs, which adds a layer of familiarity for some.
Wow. Okay, so we've covered a huge range, from MMFs, basically supercharged savings accounts right now, all the way to crypto and startup equity. 10 very different paths for that initial $1,000.
And that variety really highlights the most important point. Investing is deeply personal. There's no single right answer. But there is a golden thread that runs through choosing any of these options. It comes down to asking yourself 4 crucial questions before you invest a single dollar.
Okay, what are those 4 key questions everyone needs to answer for themselves?
First, how much risk are you actually willing to take? And be honest with yourself. Think about your sleep at night level, not just your optimistic hope level.
Right. Crucial difference.
Second, what's your main goal? Are you aiming purely for capital growth, making that $1,000 grow as big as possible? Or is generating regular income more important? Or maybe a balance of both? Third, what's your time horizon? Are you investing this money hoping to use it for a down payment next year? Or is this for retirement 20, 30, 40 years down the road? Short-term goals need lower risk approaches.
Okay, risk, goal, time. What's the fourth?
Fourth, and people often forget this, do you have a reliable income stream beyond this initial $1,000? Can you commit to investing regularly over time? Consistent investing, even small amounts, is incredibly powerful due to compounding. That first $12,000 is just the start.
So risk tolerance, goal, time horizon, and ongoing ability to invest.
Answer those 4 honestly, and the list of 10 options will naturally narrow down to the 1, 2, or maybe 3 that make the most sense for you right now. And that leads to the final thought, maybe the most important takeaway from all of this. Never, ever compare your investment journey or results to someone else's, especially not what you see on social media or hear in casual conversation. You always lack the full context. You don't know their starting point, their actual timeline, their risk tolerance, the luck they had, the mistakes they didn't tell you about. Focus on your own plan, built on your answers to those 4 questions. Stick to it. That's how you win your own race.